Welcome back to this week's market update. Today is Monday, September 29th, 2025, and we will jump right in. Markets cooled last week as investors digested the inline PCE inflation data and eyed a potential government shutdown set for tomorrow at midnight. By Friday, September 26th, the Dow Jones Industrial Average slipped 0.15%, followed by the S&P 500, which slipped about 0.3% last week, and the Nasdaq Composite, which was down 0.65% last week. Moving into our economic news from last week, as I mentioned, we did get the PCE inflation report for the month of August. It showed headline inflation at an annual rate of 2.7% in the month there, and core inflation at 2.9%. Now, these being below 3% is certainly a positive. However, you can see we've been trending up pretty steadily since May, so this is definitely also a cautionary data point we want to take a look at, even though it did come in line with expectations. Alongside the PCE inflation report, we also get some great data on personal income, spending, and saving. For the month of August, we saw personal income rise by a pretty healthy 0.4% month over month, while spending grew at a slightly higher 0.6% there. This pushed the personal savings rate modestly lower to 4.6% here as of August. Overall, this highlights a consumer base that remains willing to spend with some healthy income growth as well. Although you can see the last 3 months, we've had spending rise at a faster pace than income. So overall, pretty stable here. You can see we had this one outlier month, but it does look pretty strong, pretty stable, despite the personal savings rate slipping slightly. We also got some pretty strong new home sales data last week, showing that new home sales surged 20.5% in the month of August and were up 15.4% compared to a year earlier. The sharp rebound was in part driven by a pullback in mortgage rates, with the average 30-year fixed rate falling from 6.72% at the end of July to 6.56% by late August. The median sales price also ticked higher, climbing to $413,500 here from July's $395,000, reflecting both improved demand as well as some firming in pricing power among home builders. Existing home sales saw a less pronounced boost in August, with volumes up 1.8% from a year ago, but slipping 0.2% from July. Inventory continues to build with 1.53 million homes for sale. This was up 11.7% from a year ago. Supply rose to 4.6 months worth there, signaling a gradual shift towards a more buyer-friendly market. And then lastly, prices were pretty steady, with the median sales price up 2% year over year to $422,600. Compared with the sharp rebound in new home sales, the existing home market reflects a slower pace as inventories continue to rise, but we are still seeing a pretty modest appreciation in prices. Last but not least, here for the week's economic data, we did get a pretty substantial upward revision to Q2 GDP data, showing that real GDP growth came in at 3.8% here for the second quarter, according to the third estimate last week. The upward revision was driven by a upward revision in consumer spending, slightly better investment, government up slightly, exports down slightly, so those detracted from it, and then imports, which are a subtraction from GDP, that was revised slightly lower as well. So those components contributed to the change. With positive revisions like this, markets are hopeful that we will get 1 or 2 additional rate cuts and that the Fed can steer the economy towards that Goldilocks scenario, not so hot that inflation reignites, but not so cool that growth slips into recession. But for now, with this most recent quarterly GDP growth data coming in just shy of 4%, this is a good indicator that the economy seems to be faring fairly well in recent quarters. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.